Why do markets exist? Part 3. We're on to day 3 and we're continuing our conversation about why do markets exist. We've been talking about the commercials over the last two videos, and so one of the things that came out is it seems like the commercials are always right, and by and large they are always right. They are the experts. They know more about the product than anybody does. They know the cost of freight. They know the cost of financing. They know everything about the supply demand of that product. So the commercials tend to know the most about the product, and the commercials tend to be the experts. And yes, most often they are right. So why would anybody trade against the commercials? Well, a couple of things. One, sometimes the commercials are just wrong. And where they are typically wrong, how can somebody be an expert and be wrong? Well, they tend to be wrong in a couple different factors, a couple different ways. They're wrong, one, when there's a catalyst that they didn't expect. So it could be a hurricane, could be a drought, could be an active war, a terrorist attack, something like this where the commercials have built into a big position, but now the situation dramatically changes in an instant and they're stuck. And now they will have to cover. And when they have to cover, they are going to lose a lot of money. So when commercials trade, commercials tend to make and make and make and make and make. But when they're wrong, they tend to be wrong big. So that's one of the things we look at. So if you look at the flip side, if you look at, well, why would you trade against a commercial? You have hedge funds that trade against commercials all the time. And why is that? Why do they do that? Well, a lot of the hedge funds build quantitative models, and they use their modeling to generate signals across an array of products. And the hedge funds know through their quantitative models that they will be wrong a lot, but when they're right, they'll be right big. And they're somewhat agnostic as to where they're right or wrong. They don't really care. They just know what the models tell them. So when that's the case, they might be wrong in 6, 7, 10, 12 markets, but they'll be right in one. And the one they're right in, they'll make big. So when we talk about a commercial being wrong and having to cover and lose a lot of money, when they have to cover, they typically have to cover to the hedge fund. The hedge fund is long, the commercial is short. The commercial gets run out because of a catalyst or whatever the other reason is, and it's the hedge fund who sells it to them. When that happens, that is typically the top or the bottom. So what's interesting is that short-term and intermediate-term tops and bottoms, they get put in by the commercial selling into strength and buying into weakness, and doing so in greater and greater intensity. So if the market is rallying, commercials sell, 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 and then finally whoever's buying will get tired of buying, and then the market will come back in. And then the commercials will start to buy it on the way back in. That's what happens when the market is in a short-term or intermediate-term top or bottom. But when we see major inflection points, major tops, major bottoms, those are usually put in by the commercial firm being wrong. And when they put in the top, they're typically buying it from the hedge fund liquidates into it, and when that is done, the market typically goes into a free fall and falls all the way back down because there's nobody left to buy it. And the whole process begins again. So what's interesting is every market in every time frame has a fair value. And that fair value is when the supply and demand of the market come into balance. But this fair value is elastic and it constantly moves. So a fair value may only be a fair value for a few days or a few weeks or maybe a few months, but it's going to move. And why is it going to move? Because supply and demand move. So mathematically, everybody's always trying to define this as like an absolute number. But it's never an absolute number. Fair value is never absolute. It's always relative and variable and elastic. So when we look at why do markets exist, as I said, a market exists to facilitate trade. I'll share one other interesting aspect of this. So a lot of times we'll see government policies come into place to try and fix rents, to try and fix the cost of food, to try and fix the cost of fuel. And they'll publicize this as we're looking out for the little guy by trying to make sure their costs don't get too high. But what's really interesting is you're fighting a force of law, a natural force, which is the market. And when you put a rent control, a price control in place, what ends up happening is the first thing you do is you take price discovery out of the regular market and you move it to the black market. The market will not be stopped, ever. This is important to understand because a lot of politicians think that they can stop the market or they can freeze prices or this or that. Bullshit. The market will not be stopped. So if you freeze a price in one place, you're just going to drive it someplace else. You're going to drive it off, and you're going to drive it off a computerized platform, and you're going to drive it into an alley. You're going to drive it into a warehouse, where now it will be dangerous to conduct in this product, but it is still going to transact. And you can see all kinds of examples of this. So that's an interesting facet of markets, is that they will not be stopped. If you try and stop them, they'll just morph into black markets, where things become more dark, more dangerous, but still price will be discovered and the market will facilitate trade. So that's it for tonight. A couple things to think about for yourself is just as you look at markets, do you know who the commercials are in the markets that you watch or that you trade? Do you know who the natural long is? Do you know who the natural short is? And do you know what are the conditions that they're going to show up in the market? I do a lot of commodity trading, and I look at commercial behavior heavily in commodities and in a lot of different futures contracts. So a great example, and I'll close off with this. Right now, RBOB, which is unleaded gasoline, it's a derivative of crude oil. RBOB is an incredibly strong commercial name right now. You have a lot of different variables that are going into RBOB that are showing that commercials are actually trying to buy unleaded gasoline. And this can be seen in the commercial positioning, this can be seen in spreads, this can also be seen in seasonals. So this is, and it's a leading indicator. The behavior of commercials leads everything else, which is also really valuable. So look at that for your own trading. Think about that. And we've got a number of things coming up. You can go to tradingmatrix.com where we have our free options webinar, our free options lesson that you can do. We have our next Red Pill Challenge starting next Friday, February 18th. You can sign up for it here on the page. If you're new to options, you're new to trading, this is a great course to start. It costs $99, but if you do every lesson and you do the homework, you get the $99 back. So you can do this course for free. Most of our students pay the $99, they do all the work, and they get it back, and they love it. So I encourage you to check that out. So everybody have a great night. God bless, and I will see you tomorrow.